If you're a contractor, getting a mortgage can be easier than you think, but it has to be done the right way. So in this video, I'm going to explain exactly how contractor income is assessed, why day rates are more important than pay slips, and what you need to do before you apply for your contractor mortgage. If you're a contractor, some lenders allow you to be treated as if you're employed. So they completely ignore your limited company accounts or your sole trader accounts, and they're purely just looking at your day rate. There's a couple of ways that the lender will assess your day rate. Some lenders will only give you 46 weeks. Some lenders will give you 48 weeks when they're averaging out your annual income. But that's just to take into account for holidays, any days off sick that you may incur. As you're being treated as employed, we're literally using your gross day rate. So what the lender will do is they'll take your gross day rate, times it by the number of days you work in the week, and then times that by either 46 or 48 weeks to work out your annual gross income. And then that's the income figure that we can use for mortgage affordability. The great thing about this is that gross day rate figure is going to show a lot higher income than what either your salary and dividends are from your limited company or what your net profits are from your sole trader business. And that's purely because we're effectively using your gross turnover figure to get you a mortgage instead of your lower taxable income after your expenses, your food, your petrol, and all the running costs for your business. So it's a great way to be able to get the mortgage that you actually want, not the mortgage you're being told to have. Day rates matter more than pay slips, simply because what we're going to do is use your day rate rather than your net income. Because we're using your day rate, it means that you can borrow a higher income multiple because we're going to show a much higher income than if we were using your net pay or your lower taxable figures. One of the major benefits of this is because you're being treated as if you're employed, you can use all the advantages of being self-employed to reduce your tax liability. But at the same time, because we're using your gross day rates, you can borrow as if you're employed. What you need to know before applying for your contractor mortgage is so simple. All the lender's going to do is ask you for your contract and your bank statement. And the reason they ask for this is that they want your contract so they can see what day rate you're earning, they can see your start date, and they can see when the contract's due to finish. Depending on the lenders, some lenders want a certain amount of months at the end of the contract. Some lenders will ask you to get a renewal. So it just depends on the lender for how long you need at the end of your contract. But generally, everyone's just going to ask you for your contract and your bank statements. And then what they're going to do is have a look at your day rate in your contract and make sure you've been paid it into your bank account using your bank statements. And that is the only income verification that they'll do. They'll not look at any company accounts, any SA 302s, any taxable pay. They won't ask for any accounts reference from your accountant. It's purely based on your contract and then the money that's gone into your bank account. And that is it.